to the Capital Discussions Roundtable. I'm Tom Nonamaker with our guest Nagaraj. And before we get started, a quick disclaimer: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And just a reminder, this is for educational purposes only. So with that, I will turn the ball over to you, Nagaraj, and this is the first time on the roundtable, so welcome. And we look forward to your presentation. A lot of John Locke followers and a lot of people like the weekly, so this should be an interesting presentation.
Yeah, I'm sure. Yeah, I've heard a lot about John Locke's, and that's what drew me to his strategy. And I wanted to tweak it to my style, and here I am. And thanks for inviting me. I'm honored to be here.
Oh, we're happy to have you.
Yeah.
So just go ahead and share your screen. If you're on Windows, I think it's Control-Alt-D. You should do it.
Okay, I don't see Control-Alt-D. You said?
Yeah, that'll share it on Windows.
Okay.
There we go.
You will see my screen?
I do. A rationale behind development.
Okay, yeah, different slide. Okay, we go into the slide share mode. Okay. Yeah, good afternoon, everybody. My name is Nagaraj Ramakrishna. I'm a mechanical engineer by profession, not a full-time trader, aspiring to be, but I do this on a very regular basis, and it's a big part of my income. So I consider myself a serious trader. And today I'm going to talk about one of the several strategies I trade on a regular basis, which is the short-term M3. I primarily use SPX weekly options for this strategy, except the last few weeks I have been using Russell 2000. And the reason is after the August crash, SPX weekly options have been priced weirdly, and it was very expensive to enter and hard to manage. So I've been using RUT lately, but for most of my testing and my live trades were done using SPX. So let's just keep the title as SPX. And this is the same disclaimer page that Tom just showed. I'm not going to spend too much time here. I'm going to move on. M3. Now, I don't think I really need to introduce M3 to this audience. It's invented by John Locke and primarily it's traded using Russell 2000 options. Like it's entered 50 to 60 days to expiration with a deep in the money call plus a out of the money butterflies. And it's adjusted as the market moves by monitoring the Greek and Greek trends. So you not only look at current Greeks, and you also project what the Greeks are going to be a few days from now before you make an adjustment. Okay. Some of the modifications I made to this strategy are instead of so 50 to 60 days from expiration, I do it like 15 days. The reason I did this is once I purchased the course and I started trading it, I found out that most of the money is made during the last 2 or 3 weeks. It was very slow moving, probably because of the market conditions or my inexperience. But regardless, no, I found out that the money is made during the last few weeks. So I decided why not just start the trade late and take it from there. And I used I used SPX instead of Russell 2000 because the fills were so hard. Russell Weekly doesn't have enough volume. So you use SPX options. And the monthly M3 takes about 50,000 capital per unit. And in this case, it's going to be a lot lower. It's about 20 to 30,000. And due to the short-term nature of the trade, it always has a high gamma. We have to live with it. We have to just watch the market more frequently than on a monthly M3. And the profit target is also going to be a lot lower. It's going to be 3 to 4% instead of 10%. And since we have several entry and exit opportunities, so it kind of makes up overall. The rationale behind a development. And I just talked, the Russell monthly had most of the action during the last few days of the trade. So I said, why not start the strategy late? And I experimented with Russell weeklies, but the fills were hard, and it took almost 7 days to close a trade, unlike on FPX. Okay, the pricing on Russell 2000 seemed unfair at that moment of testing. Not so much currently. The SPX options are way more expensive because of its inherent movement. And SPX M3 could be done with 50 points instead of 30 on Russell. Again, that had to do with the pricing. And one of the main reasons I'm presenting today is to encourage the community to expand their comfort zone and think more independently and tweak it to their liking and make it their own strategy. Yeah, I had to throw this one in here. I'm always asked, what's the right time for entry, and when do we enter? Do we do this every time? No, Calvin Hobbes is one of my favorite comic strips. He says, you never know when the right time is going to be, so you just find the right place and hang around. So that's what I do. I pretty much enter every week and on a Wednesday, and I try to pick a time when the corresponding futures, which is ES or E-mini S&P or E-mini Russell 2000, which is TF, is consolidating, just so I can avoid getting a bad fill on one of the legs. So it's up to you. You just have to create a timing rule or a price rule and just enter every week. We'll move on to the examples. I apologize if I seem too fast. I'm kind of hard pressed for time today. I need to be somewhere. So I'm going to go as fast as I can and field any questions through Tom. Is that okay, Tom?
Yeah, you're doing fine.
Okay, good. Okay, I picked some of the example trades to show you. I'm going to use OptionNet Explorer to demonstrate my trades. I have a little note sheet here giving my timings when I adjusted and entered. So I'm going to move on to OptionNet Explorer. First trade I'm going to show is March 4, 2015. By that, I mean 4th Friday of March, expiring on 4th Friday of March. It was entered on the 11th of March at about 7:30.
At 7:30 Pacific?
Oh, yeah, I'm in Pacific, right? So all Pacific time. Okay. So that's March expiring on the 27th of March. I pick a long call first to begin the trade. So I pick one that has a 80 delta. It's March 11. SPX 2000 had. I'm sorry, I'm having a hard time here finding my right strike price. The market probably moved a little. Let me just go 5 minutes back. Okay, my record shows something different. So let's just do it as we go here. So I pick a strike price which has 80 delta. So in this case, it's going to be 1990 call. And then I do a butterfly 20 points below the market, which is going to be 24. So 2025, centered at 2025. And in this case, I think I needed about 9 butterflies per long call. So 2025. Right. So I choose the number of butterflies such that the whole combo has a delta, slightly delta negative or a delta neutral. Okay. In this case, we have 1:9 ratio. And so, do you want me to step through each hour, or how do you want me to do this, Tom?
It's up to you. It really depends on how much is changing, I guess.
Okay, not much changed on this cycle. The next adjustment was on the 16th. So I'm just going to quickly step through each hour. Okay. So you will see some aberration in pricing. The option net explorer sometimes doesn't pull the right historical pricing in. So it's about, you see about minus 300. So we are aiming for 600 or 600 to 800 per unit. This is each long call is I consider it as a unit unit M3. So I'm aiming for 600 to 800, which works out to 3 to 4% of my set aside 20,000 capital. Okay. I'm gonna breeze through days and move to 11th, 16th. Okay. So usually I try to time my adjustments such that I stay under the tent. So I'm moving on to 11th, 16th. The next adjustment was at 9:20. Okay. What I did was I removed the 2025 butterflies and initiated 2050 butterflies. So -9. Is the extreme 55. That flattens the profile again. Commit in.
And you reduce the size of the butterfly a little bit?
On the upside, you always reduce the number of butterflies. On the downside, you end up increasing it by 1 or 2 butterflies.
Okay.
And we step through each hour. I ended up closing the trade at 8 a.m. So I'm just going to step through that. Okay, something's off here. Let's just for the heck of it, take it through the closing time. Okay, for some reason it's not matching with the price I have in my live trades. So, but regardless, I closed the trade at 8 a.m. on 3/17.
And Dave Thomas had a question. What was your trigger to roll up the butterflies from 2025 to 2055?
I try to stay 20 points below the market and also under the tent. But what triggered in this case was the SPX went outside the tent and I had to move it 20 points. I'm sorry, it was 25 points forward. Did that answer?
I think so, yep.
Okay. Yeah, there we have an exit point. So I'm going to go ahead and close the trade here. Okay. The next example I have is the second Friday of April 2015. Was entered on the 25th. So 25th of March. So it's March at 7:50. Again, I choose a long call that has 80 delta. In this case, it was 2050. Market moved since I entered. My record show I have it at 2050, so I'm going to stick to that. And I enter 12 butterflies at center at 2070. Doesn't look right. I'm sorry, it was 6 butterflies. Okay, there. That looks like the well-known M3 profile. Commit to it. Okay, this was adjusted by moving the butterflies down on the 26th. So let me step through so the trade each hour. Okay, so SPX has moved quite a bit to the downside before I made this adjustment. So I moved the 2050 butterflies I moved the 2050 long calls to 2030, and I moved the 2070 butterflies to 2030. 2030 brings it to 2080. No, doesn't look right. Just clear it up and redo it. $20.30. Yeah, that looks right. Okay. Right, now it brings it back to our well-known M3 profile here. Okay, let's just step through it for a couple hours. It's showing way more loss than I had faced. So something's wrong with the pricing here.
Do you remember what the loss was in live trading?
What was the question?
Oh, do you remember what the loss was roughly with your live trade?
What the log was? Yeah, I am looking at my notes. This is the timings of my adjustments, but somehow, for some reason, it won't match with what option net shows. I'm going to move on anyways, just for the sake of this presentation. And $7.30. Okay, I ended up having to adjust again to the upside by moving only the butterflies this time. I closed 12 of the 2030s and opened, I'm sorry, I closed 6 of the 1230s and opened 5 of the 2050s again. This brings us 5 here. This trade closed the next day at 7:20. Okay, I'm way off on the pricing for some reason here. It's showing a minus 1,000, whereas I made, made more than that. Okay. All right, I apologize here. No, this one does not match my notes. I'm going to move on to the third example, which was done using the Russell 2000, expiring first Friday of March. So entered February 19th. Was done using 1170 long call. No, that doesn't match my delta either. I don't know what's going on, but the option net is not matching what my records have. Let's just go through one of the trades using just the delta is what option net shows. So that's going to be my long call, and we have Russell 2000 at 12:30, so we would do the butterflies at 12:10. And had a 30-point wings, the 1:8 ratio. Let's see if that matches. Still too much of delta negative, so I'm going to go ahead and make it 7 butterflies. That's more in line. Let's just go through this as we were doing a live trade. Just going to go each hour.
Is it about how often you check it during live trading?
Pretty much, yes. I check even less frequent. I set up alerts on Thinkorswim platform, and once I get a text message, that's when I make an adjustment or close the trade. On to the next day. So we are showing about 200 something profit. So that's roughly showing 137. You would see a lot of flickering in the profit that ThinkOptim shows. Now that's because there are some deep in the money options involved. One is a long call, and other one is the upper wing on the butterfly. Okay. So now this is a good enough point to exit usually. There we go. That it reached the target without adjustments, which again doesn't line up with my notes, but no, you just take it.
Rich asked, what alerts do you set for your text messaging?
What alerts?
Yeah, what are your criteria?
Okay, in this case, let me clear this up. Oops. Okay. Okay, here I'm out of the tent at about 12:33. If Russell hits 12:33, I'm out of the tent. So that's what I would do. I would set an alert if RUT crosses, like RUT's about 12:33, send me a message. And in my notes, I also put what kind of adjustments to do for close 6 of the 20. The 12:10 butterflies and open 5 of the 12:30 butterflies, for example. I put it in the notes, and when the alert gets to my phone, I can place a trade on my phone. Okay, just go ahead, close this trade. I'm going to go back to the presentation. I had to breeze through it. I apologize again, and for whatever reason, the option net is not lining up with my notes with what my live trade showed. Oops. Okay, so those were the results I had. Actually, it's not hypothetical because this was done using my live capital. The March the 4th Friday of March, the capital used was 49,000, but that was again 3 units. And by each unit, I mean each long call is considered a unit. So 3 units of M3, I ended up adjusting it once, stayed in the trade for 6 days, and made a profit of 1,300. And the April 2nd Friday expiration made 1,400 on 2 units again. And the March 1st Friday expiration made $600. Now, of the brief testing and live trading that I've done, this is what I conclude, and this is what works best for me. I adjust it based on where I am in the tent, and also based on what the futures is doing, the corresponding futures. I watch the futures a lot, but I don't recommend it for most of the options traders because it gets highly technical. But I use that as a guide on when to adjust and when not to adjust. Sometimes it just doesn't look right. Even if it's trending, you just feel it's going to roll over. So I don't use Greeks strictly. I use where I am in the tent and also the futures. And I noticed that the fills in Russell 2000 is way harder to come by than SPX. That's because of the low volume. But it's improving, and there's a lot more Russell 2000 products, weekly products that's coming out next year, and it's only going to get better. And we have, Russell 2000 is fully electronic options, unlike SPX. SPX once a month, the monthly options in SPX are floor traded, and you'll sometimes be really surprised with how good the fills are, and sometimes you just won't get a fill. And gamma issues, that's something I don't have a solution for. That's the short-term nature of the trade. So you just have to live with it. And you have to be very strict about stop losses. I learned it the hard way. On the August trade that crashed, I took a 30% loss, which is like 3 times what my rules calls for. And it's better to live to fight another day than to just chase a losing trade. Weekly trades, but it's short-term nature, so you have to babysit a lot more than the monthly. Monthly trade, you can just get by looking at it once per day. So use both Russell 2000 and SPX. different times. There are times when Russell 2000 is way more volatile than SPX, which is most of the time, and sometimes it's the other way. So you have to decide which one you want to go with every week, and that brings some built-in diversification on your trades. And some possibly future improvements. I urge all the people listening to make it their own trade by experimenting with different adjustments. The butterfly doesn't have to be positioned 20 points below the market. It's just something that John taught us and worked best for us. You can experiment with different positions, and same goes for the long call. And the third point, the ES and TF futures is a major tool when it comes to adjustment, timing the adjustments. You can learn a lot about the market by looking at the futures instead of the index itself, because that's one major missing piece of the puzzle, the volume. The volume is really the energy that drives the market. So you need to look at the futures instead of just the index. And I have been doing the next point, the partial butterflies. I don't adjust by moving the complete set of butterflies. I move it partially these days. And I don't do the vertical because it gets so much harder to close the trade when it comes to the closing. And for margin control, you need to move the long call around. You can bring it closer on an uptrend. And also the same goes for the margin control can also be done by moving the wings. And you can stay in the trade longer by locking. There are creative ways to lock a profit by either moving the wings or moving the shorts wider and still be in the trade, hoping for some extra cash or like playing with house money. And I recently found out that in 2016, Russell 2000 is coming up with PM settled options instead of AM. It takes out a lot of uncertainty. You don't have to go in on Thursday like being nervous about where Russell 2000 is going to settle. You can take it to the next day. If you want to make a little more and take it to expiration. I think we have reached the end. I really want to thank John Locke for coming up with this excellent strategy. It's paid many times over what I paid for. So and I'm sure it's the bread and butter strategy for many of the traders here. And thank you, Tom, for having me here. Thank you all for attending. I want all of you to make this your own trade, tweak it your own style, and good luck and trade safely.
Oh, thanks. We do have a couple of questions. Rich asked, what do you mean by babysitting? How much time do you spend per day watching this?
Once an hour instead of once per day.
Okay, and then he also asked, do you have a fallen and can't get up alert? Like,
I'm sorry, what?
Crash, what happened there?
I didn't get the question. Can you repeat that?
Oh, like when the market crashed in August, do you have any kind of alerts or procedures that you go through on a big move down?
The same. I place my alert 20 points below the center of my butterfly. That's when that's like a red flag. You have to move the whole trade down, your long calls and your butterfly. I do have a downside alert, which is 20 points below the center of my butterfly.
Okay, and then Andy asked, do you have any long-term back testing, or maybe how long have you been trading this, and what kind of results have you been getting?
Okay, I back tested it for all of 2014. I had great success, and I live traded it most of 2015. I missed like I think I missed like January and February of this year. Other than that, I traded every single week, and except that August was a 30% loss, like I said. But everything else was either like a 2 or 3% loss on 3 trades, I believe, and everything else met the target.
And let's see, Bodan asked, if you watch futures, ES, why not trade ES futures options?
It's more expensive, and I have to go through some paperwork to even get approved. Just don't have the time.
Okay, got it.
Much more expensive.
Ron asked, or he said you mentioned SPX pricing is not favorable after August market crash. Could you explain that?
Sure. Now, my entry cost per unit butterfly per unit M3, I expect it to be around 13 to 15,000. Okay, and now that's by placing a long call at 80 delta and a butterfly at 20 points below the market, and the number of butterfly varies every week. But just by these metrics alone, I'm expecting the entry cost to be around 13 to 15,000, maybe up to 18,000. But after the August crash, just the entry cost was almost 30,000. Now that's because the long call, the delta of the long call is 80 when it's like 120 something points in the money. That makes it very expensive, just the volatility. And the butterfly prices didn't go down that much. So for that reason, the entry cost was too prohibitive.
Guys, for some of you that haven't been to this rodeo before, what ends up happening whenever you have a decent-sized market pullback in a very short period of time is that the put skew becomes much steeper. By that, the implied volatility as you get much further below the money, especially in the short term, if you're trading weekly, especially in the short term, is going to end up spiking. So if you were planning on buying anything like with a 80 or 90 or 95 delta on a call, right, very deep in the money. By the way, the same thing happens with your long wing, okay, at the very bottom of your butterfly. If you're buying, a 10 or 20 delta, that you're going to be paying a lot more extrinsic value for because the implied volatility spike up.
Exactly, right.
Okay, so the bottom reason, the bottom line reason of why this is that after you end up having that type of pullback, a lot of institutions, a lot of people are willing to end up paying for what they would consider to be short-term disaster insurance, so the price of it goes up. It's kind of like trying to buy, hurricane insurance the week after, South Florida gets wiped out. It's going to be more expensive.
Right. I think he nailed it. Yeah.
He is Jim Riggio, by the way, for those of you guys who don't know my voice.
Oh.
And what kind of average weekly return would you say you're getting in your live trading?
I would say around 3 to 4, roughly 3.5%. 3.5% per week.
And Andy says about, I guess, the vol skews, won't they happen on the rut also?
Yeah, they're going to happen on both. It'll end up happening on both things. The one thing that I'd also end up just making a comment is that, I kind of end up viewing, any type of butterfly, and I've known John Locke for many, many years. This is a different trade when you have, let's say, more than a month. Then when you have a month to a week, it goes into a different trade. And then in the last week, it's everything kind of speeds up on you. And your gamma risk and what you have to end up doing to control it and your strategies, I look at those things as 3 different trades. You could end up having the exact same trade on, but it's because of the way anybody who's ended up watching what I'm doing with the Kevlar, even if the market doesn't move, your deltas will change every single day when you're, out on the perimeter of the butterfly. Then they'll change dramatically, especially in the last week. So you do have to end up actively managing it, okay, the way you've kind of gone through your strategy. I think that's very important for people to realize.
And Rich asked, what's your new average entry cost per unit after August?
Okay, since I'm using Russell 2000, it's cheaper. It's still around 15,000. So, for example, I entered one this morning, and it was 15,500, so 15,500.
How wide were your wings?
50.
And how wide were your wings on the SPX?
Oh, is it 50?
Okay. Yeah,
I didn't check.
The reason why it's cheaper, right, is because the implied volatility is higher. I'm sorry, you were about to say something. I didn't mean to. I apologize.
Go ahead. That's fine.
All I was going to say is that it has to end up doing with the put skew and how high the implied volatility is, right? You have a higher implied volatility on the Russell. That's why, your pricing is going to end up being somewhat different from one to the other.
True.
Rich had a good point. He said he just finished a derivatives class, and they said the gamma is a measure of how frequently a hedged trade must be adjusted.
Can you repeat that question, please?
Oh, it's not. It's more of a statement. He said a gamma is a measure of how frequently a hedged trade must be adjusted, which makes sense. You know, you're getting
Exactly. Right.
keep watching it.
Or how fast things can go wrong against you.
Right.
Rich, well summarized, Rich.
Then Ethan says, do you set the trade up regardless of the market conditions every Wednesday?
Yes. And I try to pick a time when TF or ES is consolidating. It doesn't take much to look at a graph and tell whether it's consolidating or trending. Now, there's only two modes. Either it's consolidating or trending. And you can use like a exponential moving average. I like to keep it simple, so I only use like one moving average, which is like a 21 period, and I use a 5-minute chart or like a 2000 tick chart. 2000 doesn't quite equate to 5 minutes on TF. TF takes far less ticks, but it takes a lot more time. So I just use 5 minutes on TF or 2000 tick chart on EF. Did that answer the question?
I think so. A little discussion about the gamma, but not really related to the presentation. So, Nagaraj, any other last things before we wrap it up? I know you have to get going.
No. I urge all the people that are attending, make it their own trade, tweak it and make it their own. It's never going to be perfect, but you just have to tweak it to suit your style. So, good luck and trade safely.
Yep, and that'll be the last roundtable for the year. We're going to take next week off in the holidays just to give everybody a break, and then we'll be back in January, and I'm going to present Dan Harvey's road trip trade. So have a good holiday and a New Year's, everyone. Jim, thanks for coming.
Happy holidays, everyone.
Yes, and thanks for coming, and we will see you next time.
All right. Thanks, Tom.
Thank you.
Thanks, sorry.
Thank you all.
Thanks, Jim.